Hello and welcome to this video. Today we're going to discuss a key strategy to protecting your portfolio using a contract for difference, or a CFD, to short. So let's start with defining what shorting the market actually means. In normal markets using traditional shares, investors can only buy shares with a view that over time the share price will rise. However, as I'm sure we're all aware, it doesn't always go to plan. One of the fundamental differences between buying shares and trading CFDs is the ability to be able to short the market, short individual stocks and short commodities. Shorting the market essentially enables you to make money from a falling market. So, supposing you think that Tesco could suffer with supply chain issues, you believe that the stock could fall in value. So, rather than buying or going long Tesco's as you do when you think a stock price will rise in value, instead, you can use a CFD to short the stock. For example, you decide to sell £100 per point or sell 10,000 CFDs in Tesco at 285 pence. If Tesco falls, you make money for every point that it declines. So, supposing Tesco falls 20 pence to 265 pence, you close your position out with a £2,000 profit. That's £100 times 20 pence. However, if the share price of Tesco rises, you'd make a loss for every point that it moves higher. So imagine the Tesco share price rose to 305 pence, you would lose £2,000. That's £100 times 20 pence. So the first and most obvious reason to short the market is to make money because you think a market will lose value, as we discussed in the example. The second reason to go short is to hedge your longer-term portfolio. Make no mistake, your action of shorting doesn't drive the prices down. The reality is that prices will do what they're going to do regardless as to whether you are long or short. Hedging is the practice of covering long-term positions that you feel could pull back in the short term. Hedging is a way to offset losses or prevent a loss from going beyond a set amount, and is often used by mid to long-term traders to protect their portfolio against unfavourable movements. Some traders like to think of hedging as like an insurance policy. Now, you can't prevent an unfavourable move in the market from happening, but you can give yourself some protection in the event that it does happen. So, how do you hedge your share portfolio? Let's take a look. Direct hedging is opening a short position in the same market as you hold the share or shares. If you're protecting against a broad economic downturn, which could affect your entire portfolio, you may wish to open short positions in all of the shares that you hold. Or it could be that there's one particular company which you think may have some poor results, and you can hedge just that company by opening a short CFD position. So let's take a look at an example. Supposing that you have 20,000 shares in Burberry, but you think that the next results will be weaker before the company recovers again later next year. You could sell to open 20,000 CFDs in Burberry. If the price of Burberry falls, your short CFD position would make a profit, whilst your longer-term shareholding lost money. 6 months later, you think the price of Burberry will start to rise, so you close your short position out and leave your share portfolio to rise again. Whilst the profits made from these shorts may not completely offset losses on the main portfolio, they could help reduce the losses. There are other ways to hedge using short positions. For example, supposing you hold some shares in an oil major and you think that the price of oil is going to start falling. Now, falling oil prices can hurt profits at the oil majors, so in this case, you could short oil futures as a way to hedge your shareholdings in BP or Royal Dutch Shell position. Alternatively, for example, if you trade a precious metal miner, you could hedge with gold or silver. If you have a wide selection of stocks in your portfolio, you may decide that it's best to hedge using an index. For example, the FTSE 100 index could be an appropriate hedge if you hold a diverse range of FTSE 100 stocks in that share portfolio. And finally, a key point to keep in mind when hedging is that it is impossible to remove all risk from the market. What you're trying to do is trying to mitigate it. Remember, CFDs are leveraged, so do keep in mind good risk management practices, including the use of stop losses in your short positions. And this will help to prevent running up large losses if the price does rise, reducing the effectiveness of that strategy. So I hope this video has been of some help and gives you an idea about how to short the market as part of your investment strategy. Good luck with your trading, and do keep a lookout for our next video in this series.